You retire at 67, you worked 40 years, you paid into Social Security every single paycheck, and now the government caps how much you can earn without losing part of your benefit at 50, $1,960 a year. That is $4,330 a month. If you go over that by even $1 before you reach full retirement age, they claw back $1 in benefits for every $2 you earn above the line. You thought Social Security was your money. You thought you could collect it while working a part-time job to stay afloat. But the system does not work that way, and this cap, which almost nobody understands until it is too late, is quietly reshaping how millions of Americans are planning the last chapter of their financial lives. The wildest part: most people filing early have no idea this rule exists until their first check gets cut in half. Here is what most Americans believe about Social Security: you work, you pay in, you hit retirement age, you file, you collect. Simple. Maybe you even keep working a little on the side because the benefit alone is not enough to cover rent and groceries. That belief is not irrational. It is how the system is marketed. It is how your parents talk about it. It is the plot of every retirement planning article you have ever skimmed. The assumption is that Social Security is a contract. You fulfilled your end. Now the government fulfills theirs. Clean exchange. But Social Security is not a savings account. It is not your money sitting in a vault with your name on it. It is a pay-as-you-go redistribution system wrapped in the language of earned benefits. And embedded in that system is a penalty structure that most Americans only discover after they have already filed early and gone back to work. According to the Social Security Administration, nearly 1 in 4 beneficiaries who file before full retirement age and continue working will have some or all of their benefits withheld due to the earnings test. That is not a fringe scenario. That is millions of people. The cap for 2025 is $51,960. If you are 64 still working, and you filed for Social Security at 62 because you needed the income, every dollar you earn above that threshold costs you 50 cents in benefits. Not in taxes, in withheld payments. They just do not send you the check. And if you are in the year you reach full retirement age, the cap jumps to $115,920, but the penalty changes. Now it is $1 withheld for every $3 over. The math is slightly better. The shock is the same. Here is what that looks like in real life. You are 63. You filed at 62 because your hours got cut and Social Security was the only guaranteed income you had left. Your monthly benefit is $1,400. You pick up a part-time job that pays $30,000 a year because $1,400 a month does not cover your mortgage. You feel like you are doing the responsible thing, hustling, staying in the game. Then the letter arrives, you earn $30,000. The cap was $51,960. You are still under, so you are fine. But what if that job paid $60,000? You are now $8,040 over the limit. The government withholds $4,020 in Social Security benefits. You thought you were adding income. You were actually getting taxed on ambition at a 50% marginal rate. Now imagine you did not know the rule existed. You filed early because you had to. You went back to work because you had to. And then your benefit vanished mid-year with no warning except a bureaucratic letter you did not understand. According to AARP, more than half of early filers are unaware of the earnings test before they file. They find out after the damage is done. After the budget was built around a number that turned out to be conditional. This is not about fraud or laziness. This is about a system designed in an era when retirement meant stopping work completely. When 65 was old. When part-time gigs and portfolio careers and working into your 70s was not the norm. The Social Security earnings test is a relic. But it is a relic with teeth. And it is catching more people every year because more people have to keep working just to survive what we politely call retirement. The data shows the collision happening in real time. The Center for Retirement Research at Boston College found that 1 in 3 Americans has zero retirement savings outside of Social Security. Zero. For those people, the benefit is not supplemental. It is everything, but the average Social Security benefit for someone who filed at 62 in 2024 was around $1,298 a month. Try living on that in any mid-sized American city. You cannot. So you work. And if you work too much, you lose the benefit you filed early to claim. You are trapped between two bad options. Take the money early and accept the permanent reduction but risk the earnings cap. Or delay filing and go without any Social Security income while working a job that may not last or may not be enough. And here is the part that stings. The money they withhold is not gone forever. Technically, once you reach full retirement age, the Social Security Administration recalculates your benefit to account for the months they withheld payments. You get credit back in the form of a slightly higher monthly check going forward. The government calls this an adjustment, but it is cold comfort when you are 64 and your benefit just disappeared because you earned $55,000 instead of 51. You do not think in terms of actuarial adjustments. You think in terms of keeping the lights on in February. There is also a darker edge to this. The cap does not affect everyone equally. If you are wealthy enough to retire early without filing for Social Security, the earnings test is irrelevant. You delay until 70. You maximize your benefit. You never trigger the penalty. But if you are living paycheck to paycheck and you need that early benefit just to stop the financial bleeding, you are far more likely to keep working and far more likely to hit the cap. The system punishes the exact people who can least afford it. It rewards patience and liquidity. It penalizes desperation. Let me be clear about what full retirement age actually means, because this is where people get confused. For anyone born in 1960 or later, full retirement age is 67, not 65, not 62, 67. That means if you file at 62, you are filing 5 years early. Your benefit gets reduced by about 30% permanently, and you are subject to the earnings test until you hit 67. That is 5 years of exposure. 5 years where a decent job could cost you thousands in withheld benefits. The government does not advertise this up front. It is in the fine print. It is in the pamphlets nobody reads. It is in the online calculators that assume you are not going to keep working. Now think about what this does to behavior. You are 59. You just got laid off. You are thinking about filing early at 60. 2, if you do not find something soon. But you also know you are healthy enough to work. You hear about the cap. You do the math. Suddenly you are making career decisions not based on what you want to do or what you are good at, but on whether the income will disqualify you from a benefit you already earned. You are optimizing for a penalty structure instead of a life. That is not retirement planning. That is survival chess. Here is the shift that changes everything. The earnings test does not apply after you reach full retirement age. Once you hit 67, you can earn $10 million a year and still collect your full Social Security benefit. The cap disappears completely. That fact alone should tell you something about the logic baked into this system. The government is not worried about people working in their 70s. They are worried about people filing early and staying in the labor market. The policy is not about protecting the trust fund. It is about discouraging early filing by adding friction, by creating a trap most people do not see until they are already inside it. And that trap is getting harder to avoid. According to the Transamerica Center for Retirement Studies, 56% of workers now expect to work past 65. Not want to, expect to. The retirement finish line keeps moving. Healthcare costs are rising, pensions are gone. Wages have stagnated for decades when you adjust for real purchasing power. People are not filing early for fun. They are filing early because the alternative is worse. And once they file, the earnings cap becomes a ceiling they cannot break without losing what little stability they manage to grab. There is another layer here that rarely gets talked about. The earnings cap only counts wages and self-employment income. It does not count investment income. It does not count rental income. It does not count dividends or capital gains or distributions from your retirement accounts. You could pull $50,000 a year from your 401k and another $50,000 from stock dividends and collect your full Social Security benefit without touching the cap. But if you earn $52,000 working a regular job, you lose benefits. The rule is not income neutral, it is wage specific. And that creates a strange incentive structure where the system effectively tells you that passive income is fine, but working for a paycheck is penalized. Who does that benefit? People with assets. People who built wealth. People who have something to pull from besides their labor. Who does it hurt? People whose only income is their paycheck. People who have no portfolio. People who need to work because work is the only income source they have. The earnings test, intentionally or not, is a class filter. It is invisible to the wealthy and brutal to everyone else. Then there is the reporting problem. Social Security does not monitor your income in real time. You are supposed to self-report if you think you might go over the cap, but most people do not know how much they will earn in a given year until the year is over. Maybe you picked up extra shifts. Maybe you got a surprise bonus. Maybe your freelance work took off. By the time you realize you went over, it is too late. The Social Security Administration will find out when they cross-check your earnings with the IRS. And then they will send you a letter saying they overpaid you, and they are withholding future benefits to get the money back. No appeal, no grace period, just math. The Consumer Financial Protection Bureau published a study in 2023 showing that nearly 40% of people who had benefits withheld due to the earnings test 40%. That is not a small misunderstanding. That is a systemic communication failure. The information exists. The rules are published, but they are not delivered in a way that reaches people before they make irreversible financial decisions. And it gets worse if you are self-employed. If you own a small business or do gig work, the Social Security Administration counts your net earnings from self-employment. But there is a twist. They count the income in the year you earn it, not the year you get paid. So if you do a big contract in December but do not get paid until January, it still counts toward the current year cap. If you are close to the threshold, timing becomes everything. You have to think like a tax planner just to collect a benefit you have been paying into since you were 16. Let me paint you another scenario. You are 65. You filed at 62. You have been collecting a reduced benefit for 3 years. You are still working part-time, making $48,000 a year. You are safely under the cap. Then your boss offers you a promotion. $55,000. It is a $7,000 raise. You are thrilled. You take it. But now you are $3,040 over the cap. Social Security withholds $1,520 in benefits. After taxes, that $7,000 raise nets you maybe $4,500. Subtract the $1,520 in lost benefits. You are up $2,980 for the year. That is $248 a month. The promotion that felt like a win just turned into a rounding error, and nobody told you this would happen. That is the emotional tax of the earnings cap. It is not just the money you lose. It is the feeling that you are being penalized for trying, for taking the raise, for working harder, for not giving up. The system is supposed to reward work. That is the American story we tell ourselves. But the earnings test does the opposite. It punishes work, and it does it quietly, bureaucratically, without ever acknowledging the contradiction. So what do you actually do with this? If you are anywhere near retirement age or thinking about filing early, the first move is simple. Know the number, $51,960 for 2025 if you are under full retirement age, $115,920 if you are in the calendar year you reach full retirement age. Write it down. Build your budget around it. If you are thinking about taking a job that pays more than the cap, run the math before you say yes. Every $2 over costs you $1 in benefits. That is a 50% marginal penalty on top of federal and state income tax. You could be losing 70 cents on every dollar above the line once you stack it all together. Second, if you have not filed yet and you are still working, delay as long as you possibly can. I know that is not always an option. I know some of you need the money now. But if you can wait until full retirement age, you avoid the cap entirely and you get a higher benefit for life. If you can wait until 70, your benefit increases by 8% per year after full retirement age. That is guaranteed. No stock market risk. No inflation guessing. 8%. There is no savings account in America offering that. Delaying is the single highest return financial move most people can make if they can afford to make it. Third, if you already filed early and you are working, track your income obsessively. The Social Security Administration does not send you a reminder halfway through the year that you are approaching the cap. You are supposed to know. You are supposed to report. If you go over and they catch it later, they will withhold future benefits to recover what they overpaid. You do not want to be in that position. If you are getting close to the threshold, talk to your employer about deferring income, reducing hours temporarily, or shifting compensation into the next calendar year after you reach full retirement age. The system is rigid. You have to be flexible. And fourth, if you are married, coordinate. Spousal benefits, survivor benefits, and the earnings test interact in ways that are not intuitive. If your spouse filed early and is still working, their earnings could affect their benefit but not yours. If you are both working and both collecting, you each have your own cap. Do not assume, do not guess. Run the numbers together or talk to someone who knows the code. This is not the place for financial improvisation. There is one more option that almost nobody talks about. If you filed early and then realize you made a mistake, you have 12 months from your initial filing date to withdraw your application. You have to pay back every dollar you received, every cent. But if you do, it is like you never filed. Your record resets. You can file again later at a higher benefit with no reduction. This only works once. And it only works if you are within that 12-month window. But if you filed at 62, went back to work, and immediately realized the earnings test is going to destroy you, withdrawing might be the smartest move you can make. You just have to have the cash on hand to return what they already paid you. There is a bigger truth underneath all of this. Social Security was never designed to be the foundation of your retirement. It was designed to be a safety net for people who could no longer work. But somewhere along the way, it became the only net most people have. Pensions disappeared. Employer matches are weak or non-existent. Real wage growth stalled out in the 1970s. The American retirement system is now a three-legged stool where two of the legs are missing, and we are all trying to balance on Social Security alone. And now we are learning that even that one leg has rules we did not agree to and penalties we did not see coming. The $51,960 cap is not the villain. It is a symptom. The villain is a retirement infrastructure that assumes you have savings, assumes you can stop working at 67, assumes you planned perfectly for 40 years in an economy that gave you no margin for error. The earnings test is just the place where that assumption crashes into reality. It is where the math stops making sense. It is where people who did everything right still get punished for trying to stay alive financially. So no, this is not about gaming the system or finding a loophole. This is about understanding that the system has edges, sharp ones, and if you are not paying attention, you will walk right into them. Social Security is still worth filing for. It is still a benefit you earned, but it is not simple. It is not automatic. You pay in for 40 years thinking it is a promise. Then you find out it is a contract with fine print, and the fine print has a dollar amount attached, $51,960. Remember it, plan around it, or wait until it does not matter anymore, because the one thing you cannot do is ignore it and hope it does not apply to you. It does, and it will cost you if you let it.